We've been talking about local equities. We want to talk about European markets. I also want to talk to you in due course about what's happening with Greece. One day they say it's sold, and the next day they say, oh, no, it's not. And perhaps you can tell us about the effect of that and where we stand with the eurozone at the moment. But first of all, just an overview of the equity markets.
Evening. Yes, well, it's been started off a very positive day. Yesterday's news flow from America about the financial institutions passing the stress test. Some questions over the severity of this test and how difficult it is to pass. But nonetheless, all the US institutions went past that with flying colours. That set the tone for the start of the day being pretty positive, and certainly by about mid-afternoon, looking at the Euro 500 and specifically the banking sector in Europe, they were up about 2.25%, tailed off as the day went on slightly, but with that news flow, it really did help give sentiment a bit of a boost. Also, we had news flow out from the likes of the Saudi oil minister, who was just trying to calm fears about oil supplies, saying that Saudi Arabia would be able to pick up any slack that might be caused or created by the ongoing troubles with Iran in the Middle East.
Just let's talk about the eurozone. As I say, we get reports that sighs of relief that the Greek issue has been sorted out, and then people say, well, it isn't really, and it's going to be with us for some time. What's your reading of it?
We've far from sorted it out. I think short term there are no reasons to be panicked, as it were, by Greece. The eurozone has agreed the bailout package for Greece. The Greeks will get their money. The next date on the horizon really is the 20th of March, which is the day with which Greece will actually pay off some of these debts to some bondholders. But we still look further down the road and say that if we look at Greece as a country and the way that its debt to GDP ratios are, its gross domestic product ratios, it still has yet to fully turn that corner. And they haven't really managed to tackle both sides of the coin. They've certainly managed to tackle the austerity measures, and that was certainly something that Greece had a lot of catching up to do with the rest of Europe. However, it's not just tackling the austerity measures, cutting back on expenditure. They also really need to do something to stimulate the economy and to help bring that side of the equation up to parity. And to be honest, it's not even a topic that's being widely discussed, let alone something that's been actioned upon.
Alastair, can you just chat about equity market valuations in Europe? Because obviously from an economic point of view, the numbers still look bad, right? You've still got very weak numbers in most European countries. Effectively, you've got Europe in a recession and expected to remain in a recession for quite some time. Yet equity markets have done reasonably okay over a period of time. What do the valuations look like?
Yeah, sure. I mean, I think if we, let's say, maybe look at, the FTSE 100, for instance, it's based of companies that are by and large global. So a lot of these companies have managed to refocus their attention away from Europe and onto Asia or anywhere else in the globe, quite frankly, the BRIC countries, for instance, where they can have better returns. There's a more buoyant economy and consumer demand is greater for their goods. So where at all possible, they've managed to do that. As is always the case when it comes to equity companies and the equity markets, we're not really just looking at today and tomorrow, we're looking further down the road. And I think a lot of the companies across Europe, where they possibly could, really aggressively tackled some of their costings, which is undoubtedly employment levels, and they stripped that back as aggressively as they felt they could. They're really sitting on a lot of cash, waiting for a turn in confidence in the market. So when it comes to the likes of dividend paid out by FTSE and Euro companies, they've all stepped up the levels, or a large percentage of companies have increased their dividends that they're paying out and have helped dividend yields as far as FTSE companies are concerned. So they're sitting there having trimmed their costs, having cut where they can, having reduced their staffing numbers, having really cut back on R&D as well, the research and development side of the businesses, maybe their acquisitions as well, the mergers and acquisitions has really dried up in Europe. And so they're cash rich, but confidence poor. And I guess that's part of the reason why we see the likes of the FTSE still bobbing around that level. We are seeing very thin volumes in equity trading still, in many different products, but in the equity market particularly. So there's a real fear where companies, investment funds and the likes, they have to be buyers of the market, and all these dips really just seem to be presenting themselves as opportunities to buy rather than anything else.
Alistair, when we look around the world, we actually see most companies are sitting in favorable positions in terms of their balance sheet. They're sitting on huge amounts of cash, etc. Do you think companies within Europe are going to start to deploy that? What's the catalyst that really gets all of this going? Or do we continue to see the same sort of pattern where you're really just investing in companies that are hoarding cash?
The catalyst is going to have to be a confidence in the market that makes us believe that we've turned the corner. And at the moment, we're still really tackling the first big issue on the table, which is Greece. On the horizon, we've obviously got the likes of, say, Portugal, and their 10-year sovereign debt at the moment is yielding around about 13 to 13.5%. So that's another country that will need bailout assistance in the not too distant future. When we look at, say, further down the road, as it were, and the other countries that are next in the pipeline, we look at maybe Spain and Italy, and their bond yields have been managed to be kept under control, but that's really due to funds that have been pumped in by the eurozone finance departments to try and pick up those debts and keep those yields at relatively sensible levels and keep them away from that 7% area. We will need a catalyst to move us. We will need to feel confident that the Eurozone finance ministers and the Eurozone politicians have tackled this issue head on. And at the moment, it's very difficult to feel that confident. You can't help but feel that Germany's still playing a very aggressive, tough tactic game with the likes of the Greeks to try and really squeeze them as much as possible and really change the whole psychology of a nation there. And as yet, they haven't really put as much cash into the markets as they possibly could.
We'll have to end there. That was Alastair McCaig, Senior Trader at WorldSpreads.